So in our last video, we talked about the product or the tool that we use for the infinite banking concept. And having that right tool is important, like we've discussed. And today we're going to talk about how we design a policy specific for the infinite banking concept. Now, I'm not going to go into a ton of details in this particular video, mainly because all those details aren't all that important. I mean, they are, but they're not extremely important. What's more important to understand the concept. When you understand the concept and you understand the details, overall, they tend not to matter that much as you get further and further into it. Again, it's not to downplay it. It's just simply the reality once you start getting in and understanding the concept and how we control those flows of cash into and out of our hands, out of our system over the course of time. So let's talk and break down a couple of things. First and foremost, let's talk about what it is. So we have our dividend paying whole life insurance policy through a mutual company. And that's the basis structure for what the infinite banking concept is. And what that policy is going to comprise of multiple different things. Probably one of the most important is what's called is premium. That is the money that you're paying in and allowing the company to put to work so that they can pay that future death benefit. There's no ifs, ands, or buts about it. Like, that is what it is in its most simplistic form. Now, obviously, there's a lot of contractual things that come along with that. We talked about that in the last video, but what's important to understand is there's a couple of core pieces that make up a policy. So first and foremost, we have our base premium. So base premium is kind of like the underlying structure that the entire policy is built off of. It's the initial death benefit that is called out in the contract that says, I paid in, we'll just say $10,000 in premium, and we're getting $300,000 in death benefit. And that's that core basis on which that product is derived. So as somebody pays in over the course of time, that the cash value is going to grow. It's going to naturally grow to the point of that death benefit at age 121. That is the basic structure. So this base premium is kind of like your foundation, and then everything else gets built upon there. So let's talk about some of those things that we can add on to a base premium that are going to enhance the policy as a whole, that particularly as we think about it from an infinite banking perspective. So one of the first things that's there or present are what are called paid up additions. Now, what these typically are and what they were originally used for was it was a dividend election option, meaning that when dividends were paid based off of the base premium from experiencing profitability within the company, those dividends would go back into the policy as paid up additional insurance, meaning that they buy mini whole life contracts that are fully paid up. And those mini contracts, so to speak, also produce dividends, and they begin to compound on one another. So what those paid up additions are doing explicitly and strictly from the dividend is they are adding to the size of the policy. So that death benefit's going to continually grow year over year over year as those dividends are going to compound on one another. And because we're using really strong companies, we're typically talking 120 plus years or more of a dividend being paid in every one of those years. That history is really strong. So that continues to be something that enhances and grows the contract overall. Now, another way that we can use those paid up additions, we can actually pay in additional premium or PUAs, as some people like to call it. A given size base premium on the contract will allow for a potentially large sized amount of paid up additions to be paid into the contract. Now, the advantage to paid up additions and that what they help us to do is early on in the contract, they provide more liquidity access than what the base premium does. And that's typically only early in the contract. As the contract continues to mature, that base premium gets more and more efficient over time. And in a lot of cases, actually generates a lot of liquidity over the course of the lifetime of the contract based off of the lifetime of the person. What we're doing with an infinite banking type policy, let's say there really isn't one, but we can we can talk about it, but let's take a given policy premium size. So let's say somebody's going to pay $50,000 in premium. Well, normally in a traditional whole life scenario, somebody would just pay $50,000 in base premium, and then that would continue to earn dividends and grow over the course of a person's lifetime, etc. Well, early on in the contract, there won't be a lot of liquidity access, meaning you wouldn't have a lot of cash value the first few years within the contract. So instead of putting all of that $50,000 into a premium, into the base premium, we might perhaps say $20,000 or $25,000. We could take the other, $30,000 to $25,000, and it would go into what's called the paid up additions rider. Well, that is going to generate that early cash value. That's going to generate that early liquidity access. Because it's fully paid up insurance, you get access to the cash value within 10 to 14 business days once the contract's in force. So now we can design a contract to have more liquidity, less liquidity, et cetera, but there's all trade-offs. We are talking about an actuarial product. So anytime one lever gets pulled versus another, it impacts the contract in some way, shape, or form. And the important thing is, and this is what I do with my clients, is help them understand, why would we do something one way versus another? It's to make sure you're educated to understand what are the specific levers that are being pulled, why would we do that, and what does it do for me both in the short, medium, and long term. So those are the things that we're talking about in a lot of my client consultations. We're talking about structure, policy design, et cetera. We're going to talk through those types of things and why that's important to you and what you want it to do for you. Again, short, medium, long term, et cetera. Now, some people will try to say that, if you want to make the policy, quote unquote, as efficient as possible. Well, efficiency is a loaded concept, because do you want it to be efficient just now, or do you want it to be efficient forever? A whole life policy, a dividend paying whole life insurance policy by design always gets more efficient and continues to get more efficient the longer it's in place. It's a lot like a steam engine. When you are, takes a little bit of time, but once it gets rolling, it has a lot of power and it can go for a very long time and carry a lot of load. Now, all we're doing with the paid up additions in a contract, we're really just adding a turbocharger to get the engine moving a little bit faster. And then we're going to continue to allow that natural efficiency to take place. That's a lot of what we're doing with a policy that's designed for the infinite banking concept. So we're not going to try to get all the efficiency, quote unquote, right up front, because then that long run growth, that long run strength of that train, so to speak, just isn't going to be there. The dividend growth, all those things are going to be kind of missing within that contract. So it's about finding a balance and striking a balance that works for each client in each situation. And I think that's probably the most important takeaway, is that there is no such thing as one perfect policy design. It's, do you have one in place and in force today or not? That's fundamentally the most important thing, is that you have a policy designed for the infinite banking concept in place. If you have it, even if it's not perfectly designed, it doesn't mean it won't work well for what you're trying to do. I mean, I'll be the first to admit, my first policy that I got was much too small. It just was. It would not allow us to be able to do the banking process, the financing that we needed. My second policy, much better, but still not completely perfect, if you will, because there is no perfect policy. Would I trade it now at all? Either of those first two? Absolutely not. They work amazingly well, and I know they're going to be amazingly great in the future as well. So I have no need to go and try and change those. Again, it's about, what is your thinking? Where are you currently thinking? And rethinking that thinking, that's the stuff that matters the most. So lastly, as we talk about policy design, just to do a really brief recap, what we're talking about is we're going to take out a policy. We're going to have a certain amount structured to base premium. We're going to have a certain amount structured to paid up additions that are going to allow us to have that liquidity access within the contract. And then separately, we might explore other riders. So there might be guaranteed insurability riders that allow us to naturally increase the size of the contract over time on a guaranteed basis. That only is going to apply if you're of certain ages. However, we also have other options that we can explore. One of those might be a separate convertible term policy that you take out at the same time as your first policy designed for the infinite banking concept. And why would we do that? Well, if we are going to maximize our current health, which is going to be the best health that you're typically in at any given point is the health you're in today. It's, you could say a lot that you could get better, but we're going to try to maximize what that is. So you might take out a policy designed for the infinite banking concept, and then also a convertible term policy that's going to allow you to add to your system as it expands. As you're able to control more and more cash flow, as your income rises, you're going to need a place to put that money. So you could also have a policy that's there that you can then convert over without having to go through much of any extra underwriting or anything like that. So just again, one option there. We also may have a term rider built into the contract to allow us to be able to place a specific amount of paid up additions into the contract. And again, my point isn't to get into the weeds in this one. It's more so to just lay out the basics. These are certain components that are going to exist there. If you're really into policies and you really want to know a lot about them, I highly recommend that you read How to Buy Whole Life by Ryan Griggs. Ryan has done an amazing job of going through dividend paying whole life insurance in a high level of detail. So if you're really into that and you really like to know all those nuts and bolts, I highly recommend you do that and then get in touch with me. Let's talk through how we can structure a policy to do what you want it to do. So as I wrap up this video here, again, what we're doing with the infinite banking concept is we are essentially taking a dividend paying whole life insurance policy. We're allocating premium amounts to both base and paid up additions in a specific way that allows us to have earlier liquidity access that we can go use and deploy that capital as we see fit. And in the next video, we're going to talk explicitly about how we access that capital, and that is through the policy loan function. And policy loans are an amazing thing when you really understand how they work and what they're doing and what they do for you. It truly is a game changer for your life, at least your lifestyle in the infinite banking concept. But stay tuned. Find that video coming up next, and we'll talk to you again soon.